We're bringing quite a crazy and dramatic week to a close, but we can't expect every week to be like this week, and we can't expect every month to be like the last month was. It was a tremendously strong month, the strongest January for the NASDAQ since 2001, if I am correct. So, what are we ultimately taking away from things, and what is our outlook going forward? Well, in my opinion, earnings haven't been good. I was listening to the Apple earnings call yesterday. The stock is obviously up today, but they missed earnings. Everyone knew, so there's this whole notion that people are brushing this conference call away because, they had supply issues, or they had FX issues. These were not things and concepts foreign to people. These were known concepts, known issues that were factored into the expectations, which they missed by quite a healthy amount for the first time in years, essentially. Amazon didn't make money last year. They lost money. They lost a lot of money. I believe more than $60 billion or something like that. That's a lot of money to lose for a company that's worth the kind of money that they're worth. When you're playing at these leagues, you have to make money. That's just the way it is. You can't have this kind of valuation and not make money. Now, I get it. Amazon is a huge company. They obviously have tremendous revenue. They're not really comparable to something tremendously cheaper, but they don't trade at a very cheap multiple relative to their earnings, and neither does Apple. They're both priced as if they're supposed to grow every year. And Amazon is obviously a very difficult stock to talk about in this way, but for good, better or worse, might actually be a bad thing that that's the case. But I mean, it is a bad thing that that's the case. Apple is a very straightforward business. If they want an almost double S&P 500 multiple, they have to grow at a double S&P 500 growth rate. And they have to have a growth rate. As of right now, for this year, they're going to decrease, as far as I'm aware, decrease earnings and decrease revenue yet again. Based on what happened last quarter, we saw a decline. The decline is going to continue throughout the year. And this is what we talked about yesterday and I've talked about before. The Fed is shrinking the balance sheet. Money is coming out of the system. This is the opposite of the environment we saw for the last 2 or 3 years. It's the opposite when companies could raise prices, take prices, they chose to call it, and stocks could grow earnings. It's not the environment going forward. So it's a different picture. It requires a different paradigm. The bulls are trying to stick to the old paradigm that stocks only go up, earnings only go up, companies only grow, and you just buy because things are cheaper than they were. That's not the case. Earnings are going down, revenue's going down. Stock prices, in my opinion, should go down because stocks are a claim on earnings. And it's not just stocks. It's going to be every asset. That's just the way it's going to be. Bond yields are going up. Bonds become more attractive. That makes the risk-free rate of return higher. And when the risk-free rate of return goes higher, then the price you need to pay to take some risk has to go down, which means stocks have to go down. And guess what yields are doing tremendously the past couple of days? They're going up. And I expect them to continue to go up. The market, for a brief moment, took Powell as dovish, but the 10-year is now back above where it was, so that should imply some things. And we heard our first non-Powell Fed speaker since Powell spoke, Mary Daly, today. This is a relatively historically dovish member from San Francisco. She's talking quite hawkish. She's not even convinced peak inflation is here. So that's an immediate walk back of the disinflation thing Powell said. So expect the next couple days for there to be more Fed speak and for them to walk back Powell. And Powell speaking again Tuesday. I think that was pre-planned because he had a feeling the market was going to do something like this. They have in the past. He was right. And he'll speak on Tuesday and probably pour some cold water on the move. And it's been a tremendous move to start this year. Tremendous. So I think it's a little overdone. I think this is the end of it. But today's action's quite crazy. We saw Head and Shoulders. I'm not a technicals guy, but I know a thing or two about them. We saw a technical head and shoulders, the head being the only time the S&P 500 went green on the day. That was quite interesting. But then we closed at a head and shoulders. So when, if everything is being dictated like by technicals like that, by momentum, by just short-term sentiment, by trying to worry about the dollar made today, I mean, obviously when you're losing a lot of money, you are certainly worried about the dollar made today. So I'm not trying to shame those people, because I'm thinking that way to some extent myself as well. It's not fun to start the year, especially after getting paid and charging people all this money and then losing money for them. Believe me, it's not fun. Anyways, the market feels like it's being driven. I mean, we know retail buying is at records right now. I mean, like higher than GameStop level records, and that was insane. So we're higher than that. I don't think that's going to last forever. I think that's going to end sooner rather than later, and I think it can go away in a matter of days. If Monday is red and then Powell comes out Tuesday and that's red, that's done. That's done. People are going to see those losses, they're going to sell, and they're going to dip. It's not sustainable. What's sustainable is good prices, cheap stocks, earnings, these actual true forces that make it so you can buy a stock and not look at it. Right now, you can't buy a stock and not look at it. Nobody right now buying stocks is buying a stock and not looking at it. They're looking at it every single second of the day, unlike ever before. That's why you're seeing retail buying at such a high level. So, right now, I think it's crazy. I think there's a lot of just craziness going on, total disregard for valuation, and the fact that earnings are not only not coming in as good as expected, but are declining, contracting, and showing signs of just not growth. I mean, these companies, they're trying to get back to valuations when interest rates were zero and growth rates were very high. Interest rates are no longer zero. They're very far from zero. Last year was essentially the worst year for the bond market ever, and bad bond markets happen when rates go up. So that should show you the magnitude of what occurred. And there's just a total disregard for earnings, the actual things that matter. None of these people buying stocks right now are necessarily intending to hold them until, forever. They're intending to hold them, until they start going down. That's what's going to happen here, is people buying stocks right now, the retail wave, they're buying stocks, and as long as it's green on that number, they're going to hold it. The second it goes red, and it looks like it might keep going red, they're going to sell it. That's how this is going to go down, and it's going to be aggressive. That's how I think it's going to go down. I don't have a crystal ball. That's my opinion. That's what I see. I've seen this before. It's happened before. We saw what happened with GameStop. That was a $400 stock. It was green for a couple days, started going red, and then it didn't stop going red. So, we'll see if that happens here. That's my assumption. But that's today's video. And until next time, peace out. Have a good weekend.